IFRS 9. Yellow carries a portfolio of debenture loan assets. Now these assets are managed with a view to collecting the cash flow and then the nominal cash flow at the end of the contract. Some of these assets have interest at market, others are zero coupon bonds which will be redeemed at a premium. If you have a loan note, if you have a debenture loan note, and interest rates are 10%, presuppose it's 10,000, and interest rates are 10%. One way of doing it is every year to pay 1,000 interest, 1,000 interest, 1,000 interest, and then at the end pay back the 10,000. So one way of doing it is to pay back the interest as you go along. Another way of doing it is to have a zero coupon bond and to pay nothing in year one, nothing in year two, and when you finally redeem the debenture, you pay a premium. So if in year one you pay nothing, you'll owe them 1,000 extra. If in year two you pay them nothing, you will owe them more than 1,000 extra because there will be interest on the interest. You'll owe them 1,100. So at the end of year two, when you redeem it at a premium, you'll pay back another 2,100, being the interest of 1,000, and then the interest on the interest as well. So financial instruments can be structured in a way that you don't necessarily pay the right amount of interest because you have a premium on the redemption, which is effectively the rolled up interest on the loan. I'm enjoying it. Yeah, I'm just, making sure you understand what is sometimes thought of as a sort of technical, horrible accounting standard. Included in the debenture loan assets are convertible loans. So some financial instruments, some debenture loans, have embedded within them an option to convert to equity. And in that way, again, the coupon rate, the interest rate that would be paid, will be lower than you would normally expect because of the value contained within the conversion. And if we are issuing convertible loan stock, then we have a hybrid financial instrument, which is partly debt, partly equity, and would need to split it out if we are issuing the loan note. These attract interest and capital like normal loans, but yeah, we talked about that. Another debenture loan has similar characteristics to debenture loan liabilities carried by Yellow at fair value. Now, the directors of Yellow think this might create an accounting mismatch, and therefore the directors are wondering if there is a solution to their problem. In other words, we have three different types of financial instruments to talk about. Three different types of financial instruments to talk about. Three decisions that we have to make. But I think we first of all need to start with an overview of how we account for these types of financial instruments. Strictly speaking, a financial instrument is a contract that creates a financial asset in one entity and a liability or equity instrument in another. If I borrow money from you, I issue a financial instrument. If I borrow money from you, I issue a debenture loan, and I have an obligation to pay you the money back. I have a liability. You've lent me the money, so you have an asset. So the word loan is very dangerous, because sometimes in my life a loan is a liability. But if you've lent me the money, in your life the loan is an asset. And in my life, if I have a loan, I have a finance cost. And in your life, if you have a loan as an asset, you have finance income. So we've got to be really careful. Maybe I'm being patronising. Hopefully I'm being patronising. But it is the weekend. Do we have these debentures as assets or liabilities? Are we about to account for financial assets or financial liabilities? Well, it says they're assets, so we are dealing with them as assets. Yeah? We're holding a portfolio. We're collecting the cash flows. All right? They're liabilities when you issue them. Yeah? If you issue shares, then they become equity instruments. If you issue loans, they become liabilities. But if you hold shares, or you hold, yeah, they become assets. So we're dealing here with financial assets. If we're going to deal with financial assets, potentially, there are three types of financial asset. Potentially. And the classification name gives away the accounting treatment. Do you remember this? We have, okay, let me give you another clue. We have a mixed measurement system. So a mixed measurement system implies some are at cost, some are at fair value. So there's a mixed measurement system in operation. I'm looking for three names of financial instruments, and I don't mean David, Daphne. I'm looking for three names of financial instruments, financial assets. Amortized cost, fair value through P&L, fair value through asset. You do know it. There are three types of financial asset. The name gives away the accounting treatment. If it's fair value through OCI, it has to be at fair value, gains and losses go to OCI. If it's fair value through P&L, it has to be at fair value, gains and losses go to P&L. If it's amortized cost, there's no fair value, so there's no remeasurement, but you take the effective rate to the P&L. There are two tests. And we need to deal with the first test first and the second test second. We don't want to get the two tests mixed up. So which is the first test that we look at? Is it the one that begins with the letter C, or is it the one that begins with the letter B? That was a 50-50, which I don't think went the right way. I know some of you only did this last weekend. I know this is a very technical issue, which is why I am slowing down a little bit. Cash flow test. Cash flow test, yeah? That's the thing that you've got to get onto, cash flow test. The cash flow test is met if what the instrument does is pay you your money back plus a bit more. The cash flow test is met if the instrument gives you contractual payments on specified dates, which principally represent the repayment of the capital, the repayment of the principal, plus a little bit of interest for time valued money and compensation of risk. In other words, the cash flow test is met if it's a simple loan. If I lend you money, my God, I want it back. If I lend you money, I want it back, and I want it back with a bit more. And that's a cash flow test being met. that you have a contractual arrangement where on specified dates, specified amounts will come back to you. And if that cash flow test is met, then we call it a debt instrument, and then we open up the Pandora's box of business model. So the classification process starts with the cash flow test. Starts with the cash flow test. i.e., does the instrument contain contractual terms with specified amounts and dates, representing the payment of the principal and interest. Interest compensating you for the time valued money and a little bit of credit risk. Does the instrument contain contractual terms, specified amounts of dates, which represent the payment of the principal and the interest? In other words, is it a loan? Is it a simple, straightforward loan? If the answer is yes, then we consider the business model. If the cash flow test is met, if it is a loan, shall I say that, leave that there for a second? If the cash flow test is met, i.e. it is a loan, it is a debt instrument, then we consider the business model. Then we consider the business model. Then we consider the business model, the BM, the business model. Some of you would have heard this story before, but I'm just going to tell it again. Not everybody's heard it, and if you've heard it before, well, it's revision, isn't it? That's what revision is about. 23 years ago, I borrowed some money from the Yorkshire Building Society, and the reason I borrowed that money was to buy a property in the UK. We borrowed the money. Yeah, to buy a property. We bought a property in the UK. All right. So now, so far as we are concerned, because we borrowed the mortgage, we borrowed the money, that mortgage is a liability that we have that is paid off, every month. We pay a certain amount over the 25 years. Now, I'm holding this liability, and all I'm ever going to do with the liability is pay it off, 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 pay it off for 25 years. Now, the Yorkshire Building Society, their business model is very boring. Their business model is very patient. Their business model is to collect the money in, collect the money in, collect the money in, collect the money in. They passively sit there collecting the money in. They never have an intention. They never have a desire. They never have a plan to sell the asset. And the mortgage in my life is a liability, but the lender's life, they have an asset. And the Yorkshire, the lender, is still collecting that money. Their business model is passive. Their business model is to hold, collect, never ever to sell. because they're never interested in selling, they're never interested in the fair value. Because they're never interested in the fair value, they will have the asset at where the business model is to hold and collect the cash flows never to sell, then amortize cost. Where the business model is to hold and collect the cash flows, never to sell, then amortize cost. Where the business model is to hold and maybe sell. Maybe sell. If there's another opportunity. Some companies have this attitude that they hold it, but they reserve the right to sell it on, factor it on, sell it on. How would you then account for this? You would be at fair value, but you're not definitely going to sell it, so you're not trading it, so it would go fair value through OCI. Other business models, in other words, trading, will be fair value through profit and loss. I'm sorry, but if the cash flow test is met, everything is open. If the cash flow test is met, then the three business models are open, are possible. If the cash flow test is not met, then it's not a debt instrument, it must be an equity instrument. If the cash flow test is not met, if the cash flow test is not met, if the cash flow test is not met, then it is an equity instrument. Then it is an equity instrument rather than a debt instrument. Maybe that's a slightly archaic distinction, but you have to make it. So if the cash flow test is not met, then it is an equity instrument and must be at fair value. And must be at fair value.